On July 25, 2026, Asian markets dropped sharply in a single session as a global sell-off in AI-related shares accelerated overnight. Brent crude simultaneously crossed $100 per barrel for the first time in years. Two unrelated events, you might think. But buried inside that market movement was something most financial analysts refuse to say out loud. The AI investment bubble, the one that has been quietly inflating inside your retirement account, your pension fund, and your index fund for the past 4 years, may have just begun to crack. Most people have no idea their savings are exposed. Here is why this matters right now. Today, not in some abstract future. If you hold an S&P 500 index fund, you almost certainly own significant positions in Nvidia, Microsoft, Alphabet, and Meta. As of early 2026, those 4 companies alone represent roughly 22% of the entire index. That means every dollar you have in a standard diversified retirement account is, functionally, a bet that AI investment returns will materialize at the scale Wall Street has priced in. They have not materialized yet. Goldman Sachs published an internal analysis in late 2025 estimating that the technology sector had absorbed over $1 trillion in AI-related capital expenditure since 2022, with revenue returns that account for less than 15 cents on each of those dollars. The gap between spending and returns is not narrowing. It is widening. And the second major implication is even more uncomfortable. Retail investors, meaning ordinary people with 401 Burmese chats and ISAs, are always the last to know when that gap closes violently. To understand how we arrived here, you need to go back to late 2022, when ChatGPT launched and generated 1 million users in 5 days. That single event triggered what financial historians will likely describe as one of the fastest revaluations of an entire sector in market history. Within 18 months, Nvidia's market capitalization increased by over $1 trillion. Microsoft added hundreds of billions. The logic seemed sound. AI was real, the technology was genuinely impressive, and whoever controlled the infrastructure would control the future. Investors poured money in. But here is the analogy that makes this clear. In the mid-1800s, thousands of investors funded railway construction across Britain and America. The railways were absolutely real. They transformed civilization. And yet the railway bubble of 1847 wiped out fortunes precisely because genuine transformative technology does not guarantee that every company building it will generate returns proportional to its valuation. The technology wins. The investors often lose. The first thing most people do not realize is how deeply AI stocks have penetrated funds that are explicitly marketed as conservative or balanced. A so-called balanced fund typically holds roughly 60% equities and 40% bonds, designed to smooth out volatility. But because AI companies have inflated to such a large share of total market capitalization, a balanced fund tracking broad indices now carries AI exposure that would have been considered aggressive growth territory 5 years ago. Vanguard's Total Stock Market Index Fund, for example, held Nvidia as its third largest single position for much of 2025, ahead of companies like Berkshire Hathaway and JP Chase. That is not a technology fund. That is the fund millions of ordinary Americans use to save for retirement. When Nvidia fell 30% during a 2-week stretch in early 2025 following the DeepSeek announcement, that supposedly safe fund moved in ways its holders never anticipated. The deeper implication is this: concentration risk, the danger of too many eggs in one basket, has been quietly smuggled into portfolios that were never designed to carry it. And most account holders have not opened their statements carefully enough to see it. The second revelation is the one that genuinely overturns how most people understand market crashes. The common assumption is that crashes happen because something breaks suddenly, a fraud exposed, a bank failure, a pandemic. But the AI crash risk is structural, and it has been hiding in plain sight inside quarterly earnings calls. In 2025, Microsoft spent $75 billion on AI infrastructure, including data centers, chips, and energy contracts. In the same year, its AI-specific revenue, meaning revenue that can be directly attributed to AI products, grew to approximately $20 billion. That is a 30-year return horizon if the growth rate holds. Amazon, Alphabet, and Meta reported similar ratios. The market has essentially decided to value these companies as though the returns are already here. When Deutsche Bank ran stress tests in late 2025, they found that if AI revenue growth disappointed consensus estimates by just 15% over 2 consecutive quarters, models implied sector valuations would need to compress by 30 to 40%. 30 to 40% of the AI sector is not a correction. It is a retirement account that shrinks by tens of thousands of dollars in weeks, with no warning, no dramatic headline, and no single villain to blame. The mechanism behind this particular kind of crash is something called multiple compression, and it is worth understanding exactly how it functions, because it is invisible until it is not. A stock price is essentially two things multiplied together: the company's actual earnings and a multiplier that reflects how much investors are willing to pay for each dollar of those earnings. That multiplier is called the price-to-earnings ratio. During periods of excitement about a technology, that multiplier expands dramatically. Nvidia at its peak traded at a price-to-earnings ratio above 70, meaning investors were paying $70 for every dollar of current profit, betting heavily on future growth. Now here is the counterintuitive part. The crash does not require the company to fail. The company can be growing, profitable, and genuinely impressive. The crash happens when investor enthusiasm cools even slightly, and the multiplier contracts back toward historical norms. Think of it like a balloon. You can keep blowing air in, and the balloon gets bigger, but it does not take a pin to deflate it. Just stop blowing. When the multiplier falls from 70 back to 30, which is still historically high, a stock can lose more than 50% of its value while the underlying business remains completely intact. The complications here run deeper than most financial media will admit. The first is energy. Training and running large AI models consumes electricity at a scale that is starting to collide with physical limits. In 2025, data center energy demand in the United States grew by 40% year-over-year, contributing to the kind of commodity pressure that pushed oil prices toward $100 in 2026. That energy cost is a permanent drag on AI profit margins that analyst models have consistently underestimated. The second complication is geopolitical. The new wave of U.S. tariffs announced this week, targeting dozens of countries over forced labor concerns, directly affects the semiconductor supply chains that every major AI company depends on. Taiwan Semiconductor, which manufactures the overwhelming majority of advanced chips, sits at the intersection of trade policy, U.S.-China tension, and global market confidence simultaneously. A single adverse political event in that region does not just affect tech stocks. It cascades through every index fund on Earth. What this means for you specifically depends on how your savings are structured, and now is the time to actually look. If your retirement account is in a target date fund, open it and read the top 10 holdings. If you see Nvidia, Microsoft, Alphabet, and Meta among the largest positions, you have more AI exposure than the fund's name suggests. Financial advisors are currently recommending that investors with more than 15% indirect AI exposure consider rebalancing towards sectors with genuine near-term cash flows, including energy, healthcare infrastructure, and dividend-paying industrials. You do not need to exit the market. Broad market exits are almost always wrong. But understanding precisely what you own and why it is valued the way it is not optional anymore. The AI stocks in your portfolio are priced for a future that has not happened yet. You should know that before it does, or does not. The deeper truth is that transformative technology and profitable investment are not the same thing, and they never have been. The internet was real, and the dot-com crash still wiped out 49% of the Nasdaq between 2000 and 2002. AI is real. That is not in question. The question is whether the returns will arrive fast enough to justify prices that already assume they have. Over the next decade, the companies that survive and genuinely profit from AI will likely be among the most valuable in history. But the path there will almost certainly include at least one severe correction